Okay, so why don't we get started? If you haven't joined us in past, I want to welcome you. And as many of you know, this program is co-hosted by two of Philadelphia's preeminent sustainable investing leaders. The CFA, the Sustainable Investing Thought Leadership Group, provides a forum to advance the dialogue to further understand and clarify the risks and opportunities linked to environmental, social, and governance investment issues. ImpactPHL is a nonprofit advocacy organization helping large and small investors align their financial assets with their values to create lasting change in the greater Philadelphia region. If you're interested in this type of programming and want to get involved, I just put my name and contact information in the chat box. Let me know. We'll get you involved. So today is going to be really good. If it's built on if you owned stock in publicly traded companies, you have the power to vote by proxy on these important shareholder proposals. With the help of our panelists, we'll look beyond the headlines and gain insights into the implications that voting trends are having on companies, boards, and governance teams. So some of the items that you'll hear today will provoke thoughts and probably your desire to respond to our panelists. This is going to be an interactive program, so put your thoughts, questions in the chat box, and we'll get to those. What I'll promise you, we'll stop at 1 o'clock. So let's get started. Let's have some fun. I want to lead off with Yusuf. Yusuf, can you just tell us a little bit about yourself, about your company? But then if you could lead in, what I want you to do is just as a level setter, if you can just kind of walk us through the basics of proxy voting.
Happy to. Thank you for having me, Michael. I'm very excited to be here. This is, I think, the second time I've done an event with ImpactPHL, and so I'm super excited about it. And just a heads up, my internet, which I don't control the interwebs, has been a little funky, and so if I do drop, then apologies for it. So I'm Yusuf. I work at a company called TCW, which is a large West Coast asset manager. I've been here 2 weeks now. I'm the co-head of active ownership and engagement. And effectively what that means is across our portfolios, equities, private credit, and on the fixed income side, I help to oversee and develop a strategy to engage issuers, large companies. I joined from Engine Number One, which I worked at for the past 2 years. There I was the head of active ownership, doing something very similar, but really focused on our ETFs business and our hedge fund strategy. Before that, I was at Just Capital, a company that was dedicated and focused on ESG analysis. And I started my career at Barclays in the fixed income markets. So look, I've had a lot of experience in this world of proxy voting. And just to give a bit of some context to the conversation and where we're going today, I think we all understand that, or maybe we don't all understand, but this is something that's really important to know, is that publicly traded companies, the companies that we talk about, Fortune 500, Russell 1000 companies, all of these large publicly traded companies have a governing board. We all know this. We've heard about the board of directors. We hear a lot about how they're managed and how they are sometimes mismanaged. But the board of directors is actually hired by shareholders. And I think that is a fact that most retail investors, at the very least, don't understand. So annually, there's a meeting that happens where large companies bring forth all of their shareholders to vote on really important issues, mostly governance issues, things like the re-election of directors, CEO compensation, how they ratify their auditors. But this annual meeting tends to happen for large companies around the same time. And you'll hear us refer to this as proxy season. But this is when, again, the annual general meetings of large companies are held. So this time of year, it's really important. It usually happens between April and July for most companies, but it really is staggered depending on the annual fiscal year of the company. But during this time of year, shareholders have an opportunity to what we call file proposals at companies on corporate governance or environmental and social issues. These issues go onto ballot alongside what management proposed, again, like the re-election of directors. And increasingly over the last few years, there have been more and more shareholder proposals or proxy proposals put forth by investors, really focused on if a company is governing what we believe are risks, really importantly. And so those risks can be social risks, how they workforce related issues. They can be climate risks and climate mitigations. It can be related to targets that a company has set and understanding if they are tracking to or meeting those risks. Meeting those targets. But effectively, during this time of year, during proxy season, is when shareholders have the ability to vote on those issues, to actually use their voice to hold companies accountable. So why does this matter, right? And we'll get into a lot of this today. But over the last, I'd say 10 or 15 years, there's been a boom in passive investing, right? So think S&P 500 index. And this passive investment has caused fairly concentrated ownership of stocks. And so some of the largest S&P 500 funds own nearly 20 to 25% of these large stocks. And what has happened is these fund managers are oftentimes differential, meaning that they tend to vote in favor of management. They don't vote in alignment with what shareholders are either calling out or saying is really important to them. Just if I can provide some context on what that means is, if I think back to 2019, in 2019, there were quite a bit of shareholder proposals put forth on climate-related issues, and there were 0 that passed. And when I say passed, I mean has received more than 50% shareholder support. If you fast forward to 2022, there were a record number of shareholder proposals related to climate issues that have passed, and I think the number was 10 or 11. So there's been a really sharp incline in growth over the last few years on the focus on mitigating climate risks, the focus on ensuring that your workforce is not only paid equitably, but also is diverse. There are a number of issues that we're going to get into today. But the important things to remember is that investors, both retail and institutional investors, have a ability to vote on these issues. And those issues really are useful from a perspective of risk mitigation and accountability, and for greater transparency, which is a really important thing. And that proxy voting is a tool that we all have access to that should be utilized. So I think that's a really good starting place, a high level overview of where we can go, and then we can discuss some of the issues.
Okay. Yeah, thank you so much. I think that is a good start. And Raquel, if we could build on that, if you could tell us a little bit about ICCR, who it is that you work for, but also if you could take what Yusuf just the building block that he just laid, and if you could tell us what themes you're seeing in this particular area.
Sure, absolutely. So I'm honored to help lead ICCR, the Interfaith Center on Corporate Responsibility, which is a 52-year-old coalition of faith and values-based institutional investors. And we leverage our assets to hold the world's largest corporations accountable for their impact on the people and planet. The coalition represents more than 300 global investors with more than $4 trillion in managed assets. I've been at ICCR since early 2001, but I actually come from an ICCR member organization. It's interesting. My background is actually in faith-based organizing. ICCR is faith-based, but I was organizing around issues of corporate accountability in the Jewish community, specifically around forced labor and supply chains. And through one of my partners that did shareholder advocacy, that filed shareholder resolutions as a way of engaging with their corporate target, I was really able to see the importance of investors working, alongside movements, engaging seriously with corporations of the way that their behavior impacts all of us. And I really wanted to become part of that work. So a little bit more about ICCR. We were founded in 1971 by the pension funds of the major Protestant denominations to fight apartheid. And over the years, our community has expanded, first becoming interfaith and then bringing in not just faith institutions, but values-based asset managers, along with a range of other institutions who do corporate engagement, who file shareholder resolutions and are otherwise engaged in conversations with companies, unions, family foundations, etc. And our members never shy away from making the moral case for action, but our fundamental proposition as investors is that responsible and sustainable business practices and a strong corporate culture of ethics are in the long-term interests of both companies and investors. So we're making both the moral case and the business case for companies to do the right thing. And ICCR itself is really a collaborative space where our investors strategize about their engagement with the companies, as well as their engagement with the big asset managers on, as Yosef mentioned, the most pressing issues facing our world, the climate crisis, as well as the importance of a just transition as we address that crisis, access to medicine and nutrition, worker rights here in the United States, as well as issues in the global supply chain, human rights, lobbying and political spending. And as well, we also engage overall with policy makers on issues related to shareholder advocacy, and we work to protect shareholder democracy. So as Yosef mentioned, this is, there's a season to shareholder, to proxy season. And so with the annual general meetings in the spring, many of the proposals are being finalized and filed right now. So we're still looking at the themes that are going to emerge. But ICCR members are really energized, despite, I would say, overall the pushback on social responsible investing in ESG, to continue to engage with companies including through proxy voting. Last year alone, we saw that many proposals were filed on issues related to climate change, to the climate crisis, as well as racial justice and corporate DEI. Those were where we saw most proxy proposals. And a majority percentage of the proposals that were filed were actually withdrawn for agreement with the company. So often what happens is a shareholder proposal gets filed and the company engages with the investor who filed it and agrees that in order for it to not appear on the proxy, that they will take the actions that were mentioned in the proposal, which really shows how seriously the companies take investor concerns. So like last year, again, we saw most proposals related to the climate crisis and racial justice, corporate DEI. And then the second largest group was worker rights proposals and human rights proposals. And I really expect those trends to continue because we continue to see strong support for those. For example, one of the real bright spots of the 2023 proxy season was a worker health and safety proposal at Dollar General, which Domini Impact Investments filed in support of Step Up Louisiana, which actually received the highest ever vote for a worker health and safety audit proposal, a proposal that asked the company to audit itself to understand how workers' health and safety were impacted by its practices and understanding how those practices might pose a material risk to the company. I also really expect that this year we'll continue to see lobbying and political spending to be a theme of a number of these proxy proposals, misalignment between a company's stated values and the lobbying positions they take or the politicians they support, including through their trade associations. And I also expect that resolutions on human rights will continue to be a theme. Last year, we saw, for example, a lot of proposals around conflict and high-risk affected zones. For example, human rights material risks related to the Russian invasion of Ukraine, and also proposals around forced labor from the Uyghur region in the supply chain of companies. And now, because there is this season to proxy voting, it doesn't always mean that we're able to respond right away to breaking issues. For example, when COVID-19 happened in 2020, we didn't see really proposals on health and safety and paid sick leave until the next year, until 2021. But there is some ability to pivot. For example, just last year, when we saw the threat of the railroad strike, a number of investors filed shareholder proposals about paid sick leave for railroad workers. So I expect there'll be some of that as well, where there'll be an issue related to corporations that's in the news, and you'll see investors stepping up to hold the company accountable on that.
Okay, no, thanks. And lastly, we're going to turn to you, Andy. And if you could tell us a little bit about, as you saw, what is the power of aligning one's assets to their values? And I know we've worked together in developing the 401k report card. So if you could tell us a little bit how this whole conversation about proxy voting, how this aligns, with people's values and assets.
Sure, you're happy to. And by the way, it was good to see you all in Philadelphia 2 weeks ago. We had an event in person right there. So that was great to see both you and Corey and all of your folks. So yeah, so As You Sow is a 501c3. We're a nonprofit founded in 1992. So we've been around 31 years, focused on corporate accountability. We generally start with a lot of research. We do real deep dive on companies on issues like racial justice, diversity, equity, inclusion. We're looking at 3,000 companies across 61 key performance indicators. We look at net zero. We look at executive compensation linked to emissions reduction. We look at pesticides, regenerative ag, ocean plastics. So a whole range of issues. We do the research. And what we do with this is then we can see who are the leading companies, who are the laggard companies, and we sit down with the companies. We sit down with a laggard company, we send them a letter, we sit down with them. That's what we call an engagement. And we explain to them, look, you guys scored a 7 and your direct competitors scored a 12. And here's why. These are the 3 things they're doing, you're not. This is the cost of doing them. This would make you competitive. And here's the risk of doing nothing. So the companies look at it and go, okay, you guys are like McKinsey for free. You're like helping us here to become more competitive. You're helping us to actually solve some problems. So we see ourselves as really as creating win-wins, as joint problem solving with the executives at these companies. So that's what, and then we file resolutions. So last year we had, as you saw, 210 engagements with companies. 99 companies agreed to what we were talking about, and then 111 did not. So we filed a shareholder resolution, which is an escalation of that. And then once we did that, as Raquel said, many of them agreed to our terms, and we withdrew on 56 of them. So about 25% of the companies we engaged went to a vote. And then those votes, those votes occurred. It's a lot of work in between there. There's filing proxy exempt solicitations. There's meeting with all the proxy advisors and all the big shareholders. They're doing a lot of stuff in the media, because ultimately this is about ideas. This is about getting a company to seriously look at a concept, and to look at what their shareholders, again, as Yusuf said, the board reports to us. So we are saying these are important to the shareholders, and getting that idea out there, because some of these are very innovative ideas, and sometimes it takes a year or two for people to get their head around it and go, oh, okay, like stranded assets. We filed the first stranded asset resolution in 2013. Now everybody, it's now a common idea that companies are going to have to leave oil in the ground. They're never going to be able to commercialize them, and yet they have it on their balance sheet as an asset. So explain how that's going to work out. So getting these new concepts into the common vernacular and also into people's minds is what's critical. But to answer your question, the 401ks. So we also do an analysis of mutual funds. We look at 3,000 mutual funds every month, and we rate them on what's actually inside. A lot of people don't understand that mutual funds are these baskets of stocks. You may have 1,000 companies, may have 700, or may have 3,000 companies in them. And the prospectus only ever shows you what the top 10 are doing. So we look at every company in a mutual fund, and we identify which ones are fossil fuel companies, which ones engage in deforestation, which ones are private prison companies, which ones have weapons, all kinds of different issues, gender equality. And then we give them A's, B's, C, D, or F on these different issues. We then aggregate those up for a 401k plan. So for instance, Amazon's 401k plan, or maybe I'll do Comcast because you guys are in Philadelphia. Their 401k plan is completely invested in the extractive economy. They do not have a single sustainable mutual fund available for any Comcast employees. It's 100% and very heavily invested in private prisons as well. So then we talk to the company, and we talk to the employees, and we file resolutions with the company saying, why is it that we're saying one thing about climate, and yet all of our employees own the very companies that we are talking about? Like, what is this about? And are we engaging those companies? Like, what's the plan? And why are we so out of alignment with ourselves? So we challenge the companies to actually create a holistic alignment of their philosophy, of their goals to where the money is. And we're working now to get companies to actually transition and to transform.
No, thanks. I think it's important too, and we'll get into this, that people understand that, and number one, if you own a mutual fund, if you own an ETF, proxies are an asset. You know, there's something that it's important. It's something that you have some power with.
Well, right now, you have abdicated your right to vote in a mutual fund, but there's a new thing that's happening, just started last year and now this year. It's called pass-through voting. So BlackRock, Fidelity are now allowing the people who earn the money to actually express their wish to actually have a pass-through vote. And we're working to do that, really amplify the power of the individual to be able to express themselves.
So maybe if I turn to Raquel, and I asked, you know, so that thing that everyone looks at and said, oh, it's the big institutional investors that have the power, and there's people are saying, no, there's a shift that's happening to individual shareholders. If you could just comment on that.
Sure. I think first of all, what Andy's describing, the ability of people who are invested in mutual funds to vote is going to be really important. But I also think that despite the fact that we obviously see a lot of power with big institutional investors, no investor should ever view themselves as too small to engage with a company and make their voice heard. You know, we see, companies have an obligation to listen to the concerns of their shareholders. I think individual shareholders and smaller investors often raise issues early. And, because we're invested in the whole market, we're able to say, like, we care about, these bigger systemic risks that, maybe might be like climate change and, access to nutrition, access to vaccines that are not necessarily going to, an individual company may be making money off them. But for me as an investor, who really my investments track the market, I'm concerned about how the overall economy is functioning and making sure that those risks are being taken into account by companies. I also think that because smaller investors, ICCR members, because we're really connected with stakeholders and communities, can often are often raising issues early to companies that the big institutional investors are not hearing. So I remember, I had worked with one of our members at ICCR who had been raising issues about worker health and safety in Tyson Foods' supply chain for years before the pandemic. And yet that hit the headlines at the beginning of the pandemic when their workers were affected, and was a huge financial loss to the company, and really brought about a huge amount of reputational risk to reputational damage. So I just don't want investors, just because of the various tools that they have, to ever think that they're too small to make an impact on company behavior, because there's just a variety of ways that we can make our voices heard, and get companies to respond. And I think that shift is just going to continue to happen as we see more opportunities for individual investors to be able to vote their shares.
Yeah, no, thanks. And I think this is an opportunity too to speak directly to the board. So, Andy, if you could just tell us, and there's this whole movement, this digital voting, and how this affects individuals and 401k investors.
Well, right now,
what is
it? Right now, every vote, about 25% of each proxy, and 25% of people just don't vote. They literally get a mail-in ballot and they just throw it in hopefully they throw it in the recycling, not in the garbage. But if those 25% would vote, it could really change things. And Yusuf spoke to a resolution passing. So these are all non-binding. So we've got a 96% vote at a company. The company doesn't have to do it. However, if they don't respond, if they're not responsive, then shareholders can say, well, the company's not responsive, so we're going to vote a no confidence vote against the board. Or if we run our own board slate, we may be able to replace the board. And so that's what the majority can do, is that it triggers this need to be responsive. But other than that, it's not binding, other than a board vote. If you run a slate of candidates, whoever gets the highest votes becomes the board. And so if you look at these numbers and you think back to 2021, with Exxon. So we negotiated with the company to get 3 board seats in January. So they expanded the board from 9 to 12, and we had 3 board seats. Engine One ran 4 candidates. 3 of those people won in the election. One of theirs knocked one of ours off. So we ended up with 5, but 5 out of 12. So not a majority of the board. And the company honestly did not really make any much change, even with that kind of a thing. But if you look at the actual numbers, and I have, if the people who hadn't voted, if only like half of them, not even, maybe like 25% of them had voted for these directors, we would have potentially had a 7 out of 12 person board, and that could have changed the whole transition the whole company to actually become go through a climate transition plan to actually become a much more viable entity. So it's really critically important that we get the 25% who aren't voting to vote, that the people who are currently abdicating their right to Vanguard, who votes against these resolutions 98% of the time, or to BlackRock, who votes against us 93% of the time. So these are not our friends. If you could take that back in pass-through voting and even get 20% of them to vote in a responsible or an ESG aligned way, you could actually see real transition start to happen. And that's what, that's where we think we're heading, that people are tired of abdicating their power. They are looking around going, climate change is not only real, it's affecting my life. Every company is saying it's affecting my supply chain and my infrastructure. And yet many of the companies are doing nothing. And so it's time to actually take back our power and start to create a livable planet that we want.
Just to chime in real quick,
Sure.
at the top of this conversation, I did mention that not a lot of people know. Not a lot of people know that as shareholders, they actually do have the ability to vote, or access to do that, to even call up their fund managers and say, hey, by the way, how are you voting on this thing? And I think that that's a really, not only is education a really important piece of it, but the understanding that these both retail and institutional shareholders have the ability to speak up about the values that they care about, because oftentimes they don't recognize that these things are being called out by investors to these companies, or that there is engagements happening behind the scenes between these companies and their investors. And so, while there is a gap, I think that more and more we're entering the space where there's a greater understanding, especially as climate impacts and climate effects hit people, that they can use voting as a tool to have a conversation with either the fund manager or the companies directly on this issue.
Yeah, and this kind of begs the question: is that you've all talking about the power, everyone should get involved, but if you own mutual funds, where do you even find the issues? Where do you find what you should be doing? Because you're just get so much mail from the mutual fund companies, you have no clue, which things that you should be involved with. Is there a site? Is there a place that you could go?
Right now, you've abdicated your right. If you have a Vanguard fund, Vanguard's voting against us 98% of the time, you're going to have to ask for that right. So if you're in a company, I mean, we're trying to organize Comcast employees to have their company ask Vanguard to say, we want the right to vote. And Vanguard would say yes. And then the company you'd get an email that says, do you want to vote? You'd say yes. Do you want to vote all the time with management, against management, or they offer you a range of different policies? As You Sow has a policy called As You Vote, which is very ESG aligned. There's other policies from a company called ISS that are less ESG aligned. So you would choose one of those, and then, because if you own a target date fund, which is a fund of funds, you probably own 2,000 companies, which means you've got about 40,000 decisions to make, and no one's going to do it. So you're going to have to pick a policy and say, you know what, I'm opposed management all the time, or unlike Vanguard, I'm with management. This is why we built As You Vote, so that people could go, okay, I want to vote against, and we vote against 80% of the CEO pay packages. ISS SRI, that's considered the most green of all of the voting policies, they vote against they vote for 80% of the CEO pay packages. So we're very different, even though they.
But this is it's not counterintuitive, but it doesn't make a lot of sense. And so, Yusuf, when you look at, Andy had mentioned BlackRock, but you look at Larry Fink's annual letter, and you look at it. Beside this year there was an absence of the mention of ESG. There's one mention, I guess, of sustainable in the newsletter, but prior to that, BlackRock appears that they're at the forefront of making change in this in environmental social issues. So
Look,
aren't they? What?
Well, I wouldn't necessarily say that they've ever been at the forefront of it. I think that the reality that they own, they're one of the world's largest asset managers. They have quite a bit of heft in terms of their ability to control the narrative around what change looks like, both for the companies that they own and for the space in general, and the ways in which that the companies that they own act. The mention of sustainability, the mention of climate risk, the mention of whatever ESG means to you, which really ESG is just data that is used to assess risk. But the mention of that in Larry Fink's letters over the course of the last few years was an important marker and measure of this broader understanding that climate risk is risk, right? Like full stop. And so that's why it was really, really important that it was mentioned in those letters. Now, to your point about them being at the forefront of change, part of the reason why Engine Number One had gained so much success is because of the campaign that they had against ExxonMobil, and because of the fund that they created, which is utilized to provide people with the ability to vote, which does so in a way that is quite different than what you see for the large S&P 500 companies now. And so I wouldn't necessarily say that BlackRock, State Street, or Vanguard are at the precipice of what change looks like, but I would say that they're important actors in what types of change can happen. Again, they own, a large concentration of the largest companies, and therefore, when they support or neglect to support a shareholder proposal, that matters. That really does matter, because as Andy mentioned, companies tend to fall in line when shareholders say you need to do something. So I'm not sure if that specifically answers your question about them working behind the scenes.
To another question. So, and if I could kind of pull you into the conversation, Raquel, where if I look at Yusuf had mentioned State Street, Fidelity, Vanguard, BlackRock as the four largest money managers that are out there. Do you know approximately what percentage of the ESG resolutions that these firms are supporting?
Not enough. This year we saw a huge drop in their support for ESG proposals from 2 years ago. Vanguard only supported 2% of ESG-based proposals, down from 12% last year. BlackRock only supported 7% after supporting 20% last year, and you see similar drops from State Street and Fidelity as well. And this, given their market power, this is really concerning. We need asset managers to be forward-looking, and to really be, they can't be making statements about sustainability and ESG risks and then not actually supporting the proxy proposals that are really pushing the companies to make change. And at ICCR, we obviously see the management of material ESG risk as crucial to long-term value creation. And so, given that the asset managers are fiduciaries managing the assets of million clients, we really believe that they have an obligation to fully leverage their proxy voting powers to mitigate those risks.
But in your opinion, is it because the resolutions weren't that great, or
we're hearing that? I don't think so. I think partly it's the backlash on ESG is a huge piece of it. I think that the proposals are becoming more prescriptive, but they're becoming more prescriptive because we're seeing what the limits of disclosure. A lot of proposals say, company X, please tell us what you're doing about Y. We're, one of the things, as Andy mentioned, shareholder proxy proposals are advisory in nature, and they can't interfere with ordinary business, and they can't be directly prescriptive. We can't say company X, stop doing Y. We usually have to ask for disclosure about what they're doing on issue Y, or we can ask them to commission a study on what it would do for them to implement issue Y. But I think one of the concerns we're seeing is that we are seeing increased disclosure, and we want to see more of that linked to changes in company behavior. And so then if we're getting disclosure without a change in behavior, we're then seeing proposals that are making more direct asks of the companies. But I also think we have to understand that, that the big asset managers need to see that, again, that companies understand that these proposals are valuable in assessing risk to their bottom line. As was mentioned earlier, a number of proposals were withdrawn because the companies agreed to make changes or otherwise engage with the shareholders because they understood that the proposals helped them as a company to identify their material risk early. And so because we saw this huge drop in support from the asset managers for ESG proposals, I think that's one of the reasons why it's really important for asset owners to engage with their asset managers. It's kind of like voting, where sometimes you think, okay, I agree with my politician, so I'm not going to call them because they already know I agree with them. And actually, that means they're only hearing from the other side. Asset managers are not hearing enough from proponents of ESG, for people who support ESG proposals overall or want them to change their proxy voting record. So it's very important for the asset owners to continue to engage with asset managers to really counter this drop in support.
I think there's only one message that they hear, which is moving your money. And I think that the fact that BlackRock has completely abandoned their commitment to climate risk as investment risk, it's time to move your money and move your money to asset managers who actually do care about this. The reason that they went from this huge drop is not because what they say is prescriptive. You think about it, the 25% of the companies who actually have a resolution go to a vote, those are the most resistant companies. Everybody else is 75% have agreed to, yes, we have to make some change. So it's natural for shareholders to experience a little frustration because these companies year after year, they're resistant to any kind of change, any kind of transition plan. Last year, when you asked them to just, will you disclose? And now you're ratcheting it up. So you have to ratchet up the request as you go. And so, no, this whole idea of prescriptiveness is complete nonsense. And what it is really about is the fact that Leonard Leo, who got $1.6 billion for his anti-ESG crusade, had 21 red state attorneys general send a letter to BlackRock and Vanguard. They mentioned, as you saw, 39 times in this letter, and essentially said, if you vote for one of their resolutions, we're going to sue you for breach of fiduciary duty. And they just got completely bewildered. Now, the timing of the letter came basically right as they were voting. So they're, the compliance people, the legal people at the big asset managers didn't have time to analyze it and realize that the letter was completely an empty threat. There are now deep legal analyses out there that have been done that just say this is completely meritless, but it was a threat that was enough to get them freaked out and to become more cautious. So,
but just back up a step, because one of the things that you had said earlier is that, well, you can give your money to companies or money managers that do have sustainable funds, but it just becomes difficult to figure out who they are. And if you could just comment, Andy, on just the SEC, because what is the SEC doing with the climate disclosure and the name rules?
Well, the name rule just came out 2 days ago. So the new naming rule for funds means that the BlackRock LifePath ESG fund cannot be called ESG. I think it shouldn't probably be called LifePath either, but it's got 311 oil companies in it. And so the names of these funds are going to be changing. As you saw, did a study. Again, we analyze 3,000 mutual funds every month, and we looked at 94 funds that had ESG in their name. And we did a deep analysis of their prospectus, their name, and their holdings. And what we found, we worked with 4 graduate students from University of San Diego, just doing data analysis. And what they said is based on the prospectus, you could not predict whether this company was going to get an A or an F on ESG. Now, of the 94, 60 of them got a D or an F from As You Sow on ESG. They should be renamed. So about 2/3 of the funds, we think, will probably need to be renamed, or they're going to need to change their holdings. And all of the prospectuses need to be updated to actually contain the philosophy of the fund. And so the three things have to be linked. So that rule is it's not everything we wanted. But it's better than what we've got now. Right now, we have this, what's called an 80-20 rule. You could have a fossil-free fund that has 19% coal. You have to be 80% of what you say you are. And it just completely doesn't work. You can have all of this misleading information in the system. So we're moving toward a better place. That just came out this week. The climate disclosure rule is very simple. When a company discloses their greenhouse gas emissions, they have to be accurate, verified by a third party, and in a standardized format. Basically like what you would do with financial information. That
The SEC is,
and that has not come out yet. And I don't know that it will come out because I think they're frightened that it's going to go to the Supreme Court and that they're going to lose their power. But the Europeans are coming out with some rules that are going to be even more strict.
Is the SEC moving in the right direction with this?
The fact that they have that, the fact that they've written the rule, I mean, it took them, what is it? We've been working on this 8 years now. Just the idea that we have been asking the SEC to make sure that when a company discloses something, that it's truthful is the most basic. That's why the SEC was created, to create trust between a company and its beneficial owners. But right now, there is no trust. The ESG data that people, when you get MSCI or Sustainalytics or Refinitiv data, they're scraping bad data, putting it in a database, and everybody goes, oh, it's in a database, so now it must be accurate. It's not. It's just the companies are not putting out, they're not required to, there's no penalty for putting out misleading data. So we got to fix this. It's a fundamental.
So if you could just, take that and then talk a little bit about the politics around ESG investing and, any type of federal legislation that you see coming down.
Well, I'm not a politician, so I don't like to get into the politics of it all. But I will say, to Andy's point, things are moving slowly. And I think that that's a little bit by design. And so, the role of, my firm as an investor is to take the data that we see. And look, I've spent a long time in the data space, understanding ESG data. So take the data that we see, which at times is flawed, and then speak and engage with the company to understand where those flaws are, right? If a company is saying that my greenhouse gas emissions in 2021 is X number, and that's because of a 2019 baseline, and then you speak to them again in 2022, and they're like, oh, well, the number looks great. And you're like, well, but you changed the baseline year. So you're not comparing apples to apples. Like, that is a conversation that investors need to have directly with companies. It sits outside of the realm of proxy voting, but it is important because as investors, we want to better understand, and we want to truly understand if the companies are mitigating the risks that they are facing over the long term, right? So it is, I hear your point, Andy, that on a grand scale, the data is bad. And I would agree with that. But I do believe that it is the right and the appropriate measures of an investor for the companies that they hold within their portfolio, understand if the companies are actually doing what they say they're doing or not. And that is a measure of holding them accountable to what they say very publicly, which is really, really important.
And then Raquel, if we're looking at 18 states right now that oppose ESG investing. Is this a trend that's growing, not growing? And then if we could just kind of walk back in with you, Andy, with the letter you've received from Jim Jordan.
Yeah, I think that's a really good question. I think we may be at a pivot point because although on one hand, we did see 22 anti-ESG bills pass this year during the state legislative session, 165 were introduced. And some of those state bills that did pass were watered down thanks to the intervention of, say, state banking associations. So whether this as an issue is going to continue to have legs on a state level is a really big question. Maybe we won't. It's a little bit hard to predict what we're going to. Most state legislatures don't meet in the fall, so I think it's a little bit unclear yet what's going to happen next spring. So I think there's reason for hope. We're also obviously not obviously, but I think we're not seeing the pushback on ESG be as much of a talking point in the Republican primary in the way that we might have expected. So I'm hopeful that as a national issue, this the backlash against ESG is waning. It's a little too early to say. I think obviously there's still tremendous pressures that we're seeing federally. The House Republicans introduced 18 anti-ESG bills in July, and they're not going to pass, but they just really signify where we think that they still view this as an issue that they should be going after the SEC, going after the shareholder proposal process, and really limiting the ability of companies and investors to take into consideration ESG risks. So I am hopeful that this trend is slowly being reversed, but I think it's still a little bit of a wait and see.
Yeah.
I am more hopeful than I was at this point maybe I was last year.
And my take is that these people are just
I would agree.
that they're just terrified. They see that the extractive economy is winding down. They see that the internal combustion engine is becoming obsolete. They read the IEA reports and they know that there's not going to be demand for fossil fuels. And they also see that the market trends are shifting toward companies who are adopting justice and sustainability. The extractive economy is winding down. The regenerative economy is coming up. This is what terrifies them. And this is why they are saying, think about the message. Anti-ESG. ESG is a framework for assessing risk. Don't look at risk. That's what they're saying. Don't look at risk. What investor does not look at risk? That's what investors do. What business person does not look at risk in their supply chain, to their infrastructure, with their employees, to governance issues? So the don't look at risk issue, and we're going to restrict your freedom so you cannot look at risk, is not only anti-democratic, it's anti-freedom, it's anti-conservative, and it's certainly anti-capitalism. So this is what we're facing. But just to answer your question, and so this is perhaps why Jim Jordan and the House Judiciary Committee has opened an investigation into As You Sow and other organizations for antitrust activities. The other organizations include Engine One, where Yusuf used to work, ISS, the largest proxy voting service in the world, Glass Lewis, another proxy voting service, Aviva, big insurance company, Trillium, a social responsible investing company, Arjuna, Ceres got theirs last November, and CalPERS, the largest pension fund in the United States, got theirs as well. So they have stated in the letter that they believe that asking a company to decarbonize infringes on the freedom of all Americans. We actually think that getting a company to decarbonize enhances the freedom of all Americans. So we have a fundamental issue, and also antitrust. We're a nonprofit. We can't set a price. We don't have a product. So this is what's going on. We got this letter, and so now we sent them back a very polite letter asking them to please clarify, and we'll see where it goes from there. But I think they're kind of busy trying to shut down the government right now, so they're not paying that much attention to us at the moment.
Yeah, I'm just looking through some of the questions, some really good questions in the chat box, and so thank you for those. The one John Moore had asked the question of just if each board member could just comment on one thing that a investor can do. What an individual investor, what would that be?
I can go first. If you own individual shares, you can sign up for As You Vote. Go to asyouvote.org, and you literally can, all those emails you're getting into your email box will be rerouted. We'll fill out the ballot for you, and then you'll be able to customize them however you want. There's no charge, and you will be voting. So if you own individual shares, you can vote very, very easily at no cost. Takes under 2 minutes to sign up. So I'd say that's one thing you can do. If you own mutual funds, if it's a 401k plan, talk to your fund manager and say, I want to vote, and I also want to be able to invest sustainably. If you and your fellow, your peers do that, every company will start to transition into the power should be in the hands of the people who earn the money. The choice of how you vote should be in the people. The vote and also how you invest should be in the hands of the people who earn the money.
So Dan Block asked the question, what if it's in a 401k plan? So how does that work?
You got to go to your HR, your 401k administrator, and say, hi, there's nothing for me to invest in. If you work at Comcast, there's literally nothing to invest in. They don't have a single sustainable option. And say, I want to have this conversation. The person in HR also is invested in that way. And they're probably very unhappy because if you want a livable planet, you are invested in.
But that's investment choices if we're looking at proxies. So they're already invested.
Well, it's both. I mean, I can tell you that As You Sow is right now, we're piloting a sustainable 401k plan that's going to be less expensive than anything on the market and will have full proxy voting. It's going to be called the Livable Planet Plan. We're literally just piloting it now, and anyone will be able to join it. It's called a multiple employer plan. So any company could just say, we want that, and they'll be able to transition. So we're just starting that process. So very soon you could get your company, if you get all of your employees to say, yeah, we want to join that, you'll be able to do it. You'll save money. You'll be able to vote.
And what about you, Raquel? What is your thought?
Also, I don't want to repeat what Andy said because I think those are really important steps. So I'll make a different kind of suggestion for an individual investor. We as the ICCR every year publishes a proxy book of all of the ESG proposals that our members have filed, which is not all of the ESG proposals that are out there, but is a big, compromises a lot of the universe of them because of who are ICCR members. And if you know that you're invested in a company that has been the target of one of these emails, I would say, in addition to making sure you're able to vote in support of ESG proposals, reach out to the company, write a letter, write to them as an investor, and say, these are important to me, and help to I'm trying to understand why management might be opposing them. Say, like, look, I think that if you listen to the issues in this proposal, you'll understand why they're raising issues of material risk to the company. I think it's really important for individual investors to not feel powerless in the current system. I can give you a whole spiel on what I've done with my one share of Wendy's that I did in support of a farm worker human rights group. So I think that in addition to all the really important steps that Andy outlined, I think it's really thinking about how you as an individual can speak out as an investor on the issues that you care about, whether that's human rights or climate change, to make and again to not feel powerless because you have this power as a partial owner of the company to say, we care about your behavior.
Oh, the last is tough. My gosh. So I would say, take into account all of that. Also, if you are an investor, you do have the ability to show up at an annual general meeting. And so there is one way to not only have your voice heard, but also engage with other investors. I think that's a useful tip. But more than that, I think many of us on the call either work with or work alongside organizations that are deeply steeped in these issues. And so I think at times it's an opportunity to partner, right, with ICCR As You Sow to actually say, my institution or my company is doing this type of work. And I, as an investor, care a lot about it. How are not only those issues showing up, but how can we partner to leverage some of the data or the insights or even the voices of community stakeholders to then advocate for something. And then, so that's a recommendation. If you work at an organization or a nonprofit where you can see some partnership opportunities with As You Sow or ICCR, I think that you should do that. And then lastly speaking, there are funds out there. Understand how your fund manager is voting. Transparency is incredibly important. So I know we're supposed to give one, but those are three.
Yeah. Well, I think this spills over into the place-based area as well. So we're talking about proxy voting and the place-based or individual holdings in these environmental, social, minority-owned businesses. You're not going to get. They're not public. You're not going to be voting. But you can also keep in mind when you're looking to invest in companies or you're looking to work with owners of companies, some of these same issues that you're looking at that we're talking about today should be things that you should bring up to them, of how are they treating their employees? How are they addressing environmental issues and social issues? So there is spillover, with all of this. Matt had asked the question, Thornton, about the U.S. and abroad. Is the U.S. behind, in these issues, or are we just at a different level? That could be any of you. Hey, Corey, if you want to jump in, you could do too.
The EU is coming out with some new standards that for for reporting that I think is going to be really important, because multinationals are going to need to follow those, and those may preempt the climate disclosure rule, which may give companies the desire to put pressure on the SEC to come out with the climate disclosure rules. So that's a good thing. They're also coming out with sustainable investing rules in the UK for mutual funds that are also very nuanced, and that I think are going to be really good. And they've been trying to get those to be harmonized with the SEC fund naming rules. We've been advising both sides of the pond. So I think that's all good. Europe is always, ahead. I mean, just the precautionary principle, that you can't put anything toxic into your food unless you prove that it's safe. As in the US, we have nothing like that. You can put anything into food and then you have to prove that somebody was harmed. So they tend to be proactive. And so, I think all of this new rule, also ISB, the International Sustainable Standards Board, is going to be coming out with global definitions of materiality. Right now, we have SASB in the US, the Sustainable Accounting Standards Board. That's being merged with other groups in Europe so that there will be global definitions of what is material. The definition of material is that basically it's information that an investor needs to make a buy or sell decision. And so the SEC gives us the right as shareholders to ask companies about something that is material. It affects our finances. So that's going to standardize things. So I think we're moving toward a good place. And ESG investing is kind of, I always say it's like a gawky teenager that's becoming an adult. Like, we're actually going to get some rules that, you can't just name any old fund ESG that's, even though it's full of coal and anything, that we're going to actually have some rule that the data levels are going to get better, more accurate, because investors just want to have accurate information to make their own decisions, and they want to have all the inputs. They don't want to be restricted by some of these the folks on the political side that are saying, we're going to restrict your information that you need to make decisions.
Yeah, if I can, I agree that we're in a period right now, which I still believe is the early phases or the early stages of the integration of the impacts of the environment, of social movements, etc. And as investors, we're still trying to figure out how to measure it, how to understand what it means for companies, how to assess it over the long term. And therefore, as we're in these early stages, there's a lot of fits and starts. Like, we're pushing and pulling, we're trying to figure it out. But the important thing to remember here is that as investors, it is important to showcase what you care about, what you believe is material, what you believe is valuable, and to work with your either fund manager or whomever else to better understand like how these investors are engaging with companies to drive that change over the long term. So that I think it's really important.
Yeah. Yeah, and that kind of walks into Homer Robinson's, the risk management, that whole piece is that if you could define what that is, kind of what Andy was talking about is so important. And
Great.
Raquel,
yeah, I was also to add, I think this as well, like we don't even have to look across the pond to see where the US can be catching up. I think obviously the law that just passed in California around climate disclosure is really exciting, because even though you could say, well, it's just a state bill, it obviously is going to apply to all the major American companies, and actually by having such a robust disclosure framework will actually provide support for the SEC and their climate rule to also be more expansive, because companies, if companies who operate in California are already going to have to disclose scope 3 emissions, then it's not going to create additional financial burden if the federal government imposes that as well. So it's exciting to see California being a leader in company disclosure and helping companies manage their ESG risks. And so I think that, as you know, we are really at the beginning, and I'm just hopeful that this is something that will continue to expand and flourish. And yeah, there will be other frameworks that require American companies to improve their practices, and whether or not those are ones that our government, our federal government, takes the lead on.
No, thank you. I want to thank the audience too. We could go on. We should do this in person again. This is just really, really good. We could carry on forever with this topic, and your questions are great. And I just want to thank the speakers today. So thank you, Raquel, Yusuf, and Andy, for your time. So we're going to carry on, going forward. We have programs on October 4th. Isabel McDermott is leading the program for ImpactPHL on the catalyzing effect of funding minority-owned businesses. And October 25th, the CFA Society of Philadelphia has a first in a two-part series led by Nick Ashburn of PNC on investor standards and regulations. So look out for signups for those programs, and thank you for attending.